indexes might be up 1%, next day down 1%, back up again 1%. Is that always present, or are we in this period just now of, is it a bit more pronounced right now and a bit more, let's say, is the noise a bit louder right now?
So we're trying to position our portfolios to deliver for clients through that investment cycle. And if we look back through history, we look back through since the portfolios were put in place, that's certainly what they've done. When you think about the crises that we've had to deal with, we're speaking about now about changes in interest rates, but even if we were to go back 2 years ago, it was COVID, go back before that, we all forget President Trump and the trade wars with China. So asset markets have to deal with these things in the background. But
the main message is, if you've set your goal, stick to it, and let us navigate through the volatility. If you haven't set a goal for your investment, you're kind of in the wind a little bit. Yeah. So go back, speak to your advisor, and set a goal.
Hello everyone, and welcome back to another True Potential Do More With Your Money podcast. This is episode 116, and in the words of Frankie Goes to Hollywood, relax. This is the Staying Calm During Market Volatility podcast. And the reason you and we can all stay calm is because we've got the best in the business here looking after your money, and we have four of them around the table today. So let's meet them. Let's start with Jeff. Hi, Jeff.
Hi, Peter.
Welcome back. I'm very well, yes. Are you?
Yes.
Good to see you. Good to see you on a Thursday. Normally we record these podcasts on a Friday morning, but we're doing it on a Thursday for a change.
Bit of variety.
Absolutely. Variety is indeed the spice of life. Neil, good to see you as well. Neil Rayner.
Hi, Peter.
Welcome back to the podcast. Paul's on as well. Hi, Paul.
Hi, Peter.
Good to see you. And Mark Henderson's joining us this week as well. Hello, Mark.
Hi, Peter.
Hiya. And I feel like I've seen lots of you today, and it's nice to get in the studio with you and talk about markets, which we're going to get into very, very shortly. But first, can I just ask about the True Potential apparel? If you've watched the question and answer podcast last week, you'll know that there was a question in about the various different styles of attire that we wear. And as Greg Lang answered the question, you join True Potential, you get a gilet. You stick around long enough, you get the arms sewn on. How long have you got to be here to get the full suit?
A long time.
A long time, Neil.
A long time.
How many years is a long time? How many years have you been here?
At least 10.
10?
Yeah.
And Mark's, you've been here, well, since day one,
Since
so 15.
Since day one.
So I can tell a different calibre in the suit that you get, clearly.
His is faded. That's what
It's been through the wash too many times. Well, if you shop in Marks and Spencer's, that's what happens. Wow. Look, we're gonna talk today about market volatility. You know, it's fair to say we've had a lot of questions and comments in from clients, and we have a lot of clients, so it's not unusual that we get that kind of feedback. But it is a hot topic at the moment, and our job is not the same as the newspapers and the TV, whose job it is to apply hype and hyperbole to that and think about news cycles. We're going to try and cut well through all that today and just give you the honest assessment of what is going on in the markets, and we'll talk about goal setting and why being invested for the long term is still the right course. And we'll get into some of that very, very shortly with the team today from our investment management team. But before that, Jeff, would you just maybe touch on the week so far in markets and what you've noticed and what's been going on?
I think the real thing that the markets have been focused on this week has been very much about central banks and the response that we would be seeing from central banks to the inflation backdrop that we've been discussing for many months now, in terms of morning markets, these podcasts, in terms of what has been happening there. And really, what have we seen in asset markets this week? It's just the reaction to those policy changes starting to come through. So we saw in the US last night, the Federal Reserve increasing interest rates there by 50 basis points or 0.5%. First time they've increased of that magnitude, and we have to go back to the year 2000 for a similar rate move. Then today we've had the Bank of England increasing by 0.25%, taking interest rates, or the base rate here, up to 1% there. So that has played through in asset markets. It creates fluctuations, it creates the volatility that we'll discuss today. Different reactions in bond markets, different reactions in equity markets, but also in currency markets. All things that come together in a diversified portfolio in different ways, in terms of the impact that we see there. So really, if we take the step back from that and try and think about what's been driving a lot of that change, it's very similar to the factors that we've been talking about as an investment team, as a business over the course of 2022. It's about inflation, where it has got to. It's about the need to normalise monetary policy post a very strong economic recovery post-COVID, and those things continue to be there. Obviously, we've introduced other things into the backdrop, and we think about Russia and Ukraine, and how that's been impacting asset markets as well. So similar themes to we've been discussing through the year, really, but coming to the fore this week with central bank activity.
And was the interest rate rise today, on the day we're recording this, was that anticipated?
Yeah, very much so. The market was expecting the Bank of England to move at the 25 basis points that it did. The interesting one was probably the US last night, where there had been some discussion. A number of Federal Reserve Board members had mentioned maybe the need to increase rates by 0.75%. They did take that off the table, so we only had the 0.5, again, pretty much priced by the market at this point in time.
Yeah. Okay, well, good. Well, let's get into some of the core topic today around volatility. But actually, just before we do, Mark, I wanted to quickly just come to you, because you were one of the 5 people that set True Potential up back in 2007, and one of the founding principles and philosophies that we try to apply here is what we call skin in the game.
Yeah.
We should say that all of us and everyone here is doesn't just work for True Potential, but as a client of True Potential, has money invested with this company. So why do we take that approach? Why is that important to True Potential?
I think, Peter, right from the very beginning, we decided as a senior partner team and management and staff that when we launched a new product or a new service, that we would be the first to invest in it. So we would see what a client would see. We would see it first, and it's a case of eating your own cooking. Our wealth is dependent upon the return of the portfolios, because that's where we're invested. So it's something we can say, and we can stand in front of either clients or advisors and get that point over. We see what's happening. We see the volatility in our own daily valuations, and we look at things through the technology that True Potential provides every client. And it's exactly the same login, exactly the same app that the client gets that we use. So it is important that we actually experience what every client is experiencing, Peter, when that's happening. And a lot of what Jeff said there, what's changed, I think, in the last probably 12 months, if not, well, go back 2 years to the COVID situation, is that the speed of change is happening almost intraday, which is why we had to say we're recording this on a Thursday rather than Friday, because it's 4 o'clock now. We don't know what's going to happen in the US market between Graham editing this and it going out live tomorrow. So it's that speed of change, and there's been a lot of events happening. Yeah. And the other thing that we get from the investment management firm is if Paul's on a call with a client, explaining what's happened, explaining how we're positioning for the future, quite a few people say, am I in the right portfolio? And Paul has to stop at that stage. I know it sounds ridiculous for a client who's dealing with True Potential, but from the investment management side, the regulatory environment says that we can't say, move your portfolio. That's where Neil comes in. We'll happily invest from defensive all the way through to aggressive, but the portfolio that the client sits in should be that which is in keeping with our long-term investment objective.
Yeah. And Neil, we'll come to you, because Mark mentioned the technology there, and I've noticed there are some companies out there that would prefer clients not to have access to the opportunity to log in any day they want and see how they're performing, how their portfolio is doing. We take a different view, which is to treat people as adults and provide them with the technology to see their money, and it is their money at the end of the day. But we also do things like this podcast, and you'll see copies of True Insight in front of us and on the wall, and they're all available online on tpllp.com. You can go there and read what Jeff and you guys have all been talking about for months about inflation and market volatility and long-term goals and opportunities. But we do take a different view, which is to give clients access but also education, don't we?
Yeah, there's a lot on the app. It's been recently refreshed, and the app is probably the best in the business for giving a client exactly what they want. They've got a breakdown of their portfolio, they've got an accurate reflection of their goal, their investment amount is on there. It's very interactive. You can talk to an advisor, you can talk to head office staff if you wish. So there's a lot of stuff on there. And it's very different to a couple of years ago. I was a financial advisor 15 years ago, and I used to go around door to door selling, and it used to be give the client an update of their portfolio, which was a yearly statement, and then you used to have a cup of tea and a biscuit, and then you were on your way. But now they can just, reach for their iPhone or their Android phone and just have a look at the balance. So there's a lot more control in there for a client, and clients love it. They say the feedback that we get is, I've been onto the app, I've been onto my client site. I can see, my portfolio has gone up. I can see what, my money is invested in, and it gives the client a lot more control.
Yeah. Paul, let me, if you like, come at it from a, and I'm not an investment manager, that's your job, not mine, so I can come at it from a sort of much more like, I suppose, like a client point of view, which is I logged on to, I just went on Google actually and looked at some of the markets this week, and I see, one day various indexes might be up 1%, next day down 1%, back up again 1%. Is that always present, or are we in this period just now of, is it a bit more pronounced right now and a bit more, let's say, is the noise a bit louder right now? Because that volatility isn't ever present with investing. You know that when you invest that there is going to be volatility. Is a lot of this just being overblown by the media, or are we genuinely in a period of just a little bit more volume behind it?
I'd say, over the last 5-10 years, we've got into this environment where volatility has been quite low, and we've just been in a period, probably year to date, where we've had a lot of things thrown at markets. We've had lockdowns in China, exacerbating supply chain issues, exacerbating the inflation issue. We've had Ukraine, Russia, exacerbating commodity prices. We've had interest rates changing to try and fight inflation. There's been a lot of things to contend with, and that's making people nervous in commodity markets, FX, equity markets, and fixed income. So this type of volatility is more unusual than, say, over the last 10 years. But we'd expect it to settle down as some of these pressures start to ease, the likes of supply chains, COVID, etc. And
is that, I guess, genuinely from inquisitive here or curious, does that manifest itself in terms of day to day? As I say, you see 1% up, 1% down and back again. You might have seen that typically over maybe a week or a month. Yeah. But is it happening more within the days now? Is that what's happening, Jeff?
That's very much the point. That as Paul was saying there, we've seen volatility decline through time, and what we're seeing now is it coming and manifesting itself in daily volatility. Right. And when we take a step back and look into it, you can look at, there's an index called the VIX index. It's like the fear gauge, as people call it, and it gives you an indication as how you should think about market moves in the coming 30 days. And when we look at that, you can see it's at slightly elevated levels relative to recent past, and that's what's driving the daily moves that we're seeing in the majority of asset markets. So that is part and parcel of, I think, as Paul rightly says, some of these changes that we're seeing, changes in monetary policy working their way through, rising interest rates, hasn't been something that we've really had to contend with. But then we've actually, when you look at a long-term chart and take a step back, we just have to go back to 2017, 2018, and we had rising interest rates. What we didn't have at that point in time was just the inflation backdrop that we have today. So it's maybe a combination, as Paul's pointing out, of factors coming together that are heightening volatility, and probably a situation exacerbated by something that Mark said right at the start in terms of that speed of change, the speed of news flow coming through. It's front and centre of everybody's mind. They want to make changes, they potentially step in and do something in the market, and that, I think, is just a culmination of many of those factors together that are heightening volatility and heightening the sensitivity of the market to news flow. And
on the speed of change point of view, Mark, that you rightly touched on as well, I mean, doesn't this just go to the point that trying to, if you like, react to markets, and you hear online, don't you, about people who fancy their chances as a day trader, and I'll do it all myself, and but by the time where things are, you're always operating, if you like, behind the curve if you're trying to do that, because it's already happened, doesn't it? You'll never be able to respond that quick.
Absolutely.
And you have equipment here and terminals here and all the expertise that can get you as close to the moment as you can, but you've got no chance sitting at home trying to react to that, have you, really?
There's a couple of things that are different, Peter, than previous years. First of all, that everybody looks at the equity markets, which is understandable. That's where the news flows. That's where the headline grabbers, whether it's Elon Musk trying to buy Twitter, or how he's sunk Tesla shares just by opening his mouth at one period of time. The bond markets, that's where there's been a lot of volatility, which is unusual, and the effect of that volatility is seen in the lower risk portfolios that we're managing, defensive, cautious, and to a certain extent balanced, and I'm not sure where somebody sitting at home would go to get information about bond markets. Whereas equities, yes, you could plug in and you could have a look, you could just look at FTSE 100 and the component parts of that. So our job over the last few months and going into the future is just to say, right, well, let's take another look at the way that the funds and the portfolios are made up. For example, Paul, when he's running money in America in the growth aligned fund range, the one way to get access is through a market weighted tracker, which you're just buying every share in, say, the S&P 500 in correspondence with the size of the company. Now, Paul's made a change to the way that he buys the US market in that fund, and rather than me explain it, I'll hand over to Paul to do that.
Yeah, so that you just take the 500 and 500 companies in the index and equally weight them. So you get that diversification benefit. You take away some of those extreme valuations in some of those stocks, like Apple, Amazon, Google, and you get a much different sensitivity in terms of factor. We talk about value factor, and it's highly correlated to that. So you can get different exposures through different indexes that we use.
And I think that's maybe another point to bring out. There's two things maybe in the comments there, but one is thinking about that change within the market environment itself and that feeding into to volatility, where we've seen certainly over recent weeks some of those large US growth technology companies reporting their first quarter results, and very much outside share price reactions. I'm sure everybody saw Netflix in terms of it falling 40% when it brought through its results, Amazon similarly. So there is volatility at a stock level as well as at an index level, which when you bring that together, it's exacerbating the dynamics that we're seeing. But very much as Paul's mentioning there, the other thing that's going on is the difference in how styles are performing within equity markets. So growth as a style has had a terrible year so far, and a terrible month last month, but value has had a very good month as well, and those are the nuances that it's very hard to pick up on just from reading a headline. But there's the underlying dynamics within markets are fascinating.
This goes to another of the principles of true potential that I know the portfolios are founded upon, which is advanced diversification. And we've talked about the S&P as one index there, but I mean, if I invest or a client invests £1 or £1,000 or whatever into one of our portfolios, there are thousands of holdings within that. And just explain to maybe there are a lot of new clients watching all the time and watching the YouTube channel for the first time. So if they've perhaps missed it, just explain what we mean by advanced diversification and why it comes into its own at this sort of time. Yeah,
there's different ways to think about diversification and think about the different components. Look at different asset classes. So think about equities, bonds, commodities, FX. We can also think about through currencies. We can also think about geographic regions, so investing in the US, investing in the UK. Advanced diversification is taking it that step above and thinking about investment styles. So you can get managers that are stock pickers. You can get managers that invest passively in just index products. You can get managers that just invest in fund of funds. Or managers, so there's multiple layers, and that just enhances the level of diversification and ultimately give the client a smoother journey, especially at times when volatility spikes. And that's what we believe in, and that's what works for us.
It's the not all eggs in one basket approach, right?
Exactly, and I think added to that you have how managers and different managers get diversification within asset classes. So as we were talking there about the equally weighted S&P exposure versus just market cap weighted S&P exposure, and that translates itself also into the bond market and how our managers allocate capital within that market. And it's one of those things that I think Mark's brought it to the fore. That has been the driver of what's been happening in asset markets this year. but it's not in the front of any newspaper really.
No.
Yeah.
And it's one of those things that we try through our communications with morning markets to try and bring to life some of those dynamics within the bond market. And one of the key things about the diversification within the portfolios is our managers have been much shorter duration, so they haven't been owning longer dated bonds, being shorter duration, and that's another way of bringing just diversification into it. So it's very easy for us to slip into the way and think about and discuss it in a very general way, but it's actually the specific ways that managers can implement and can bring diversification to the solution is crucial.
Let's just dig into that a little bit more then when you talk about the managers. So I guess what we mean by that, Mark, is that if you're investing a sum of money into, say, the balanced portfolio, within that portfolio, you're going to have, as Jeff and Paul say, a little bit of, say, UBS's view of the world in their style and how they go about it.
Yeah.
We also complement that with a bit of, say, Goldman's and a bit of, well, you can tell us exactly how the fund managers we work with, but that's the power of, if you like, the portfolios that you've overseen and these guys have built, is you're getting all that influence.
You're getting influence, you're getting expertise, you're getting research, Peter, all in one place, and it's active management. So if you sit there passively and just take what the index is going to deal with you, you'll get the return there. What we've got to do is intelligently apply the information that we have to shape the portfolios and to shape them in the best way we can for the future. We've always felt that a forward-looking view is better than simply reverting back to your starting point, which would rebalance to that simple model. They have to evolve because, again, we'll repeat, the world is moving so quickly. And I introduced the bond markets there. I'll come back to equities. And if you think about what's been thrown at the equity market in the last 2 years, it's probably a century, if not a century and a half of events. You've had COVID, you know, and the lockdown, the supply chain, which will restrictions, which we'll come on to in a moment. We've had war in Europe, which is still ongoing, and again, that has an effect, and it feeds into inflation. And then you've got the economic side of it with inflation, as I mentioned there, and central banks' role in trying to control that. And they're one, and the lever that they pull is interest rates. And we've seen that, as Jeff was saying there today. And just before we came in, the BBC headline was interest rates at the highest point that they have been since 2009. So you think, oh, right, okay, we'll have a look at this. That's 1%. But it's not 1% on savings rates. The increases that we've seen in the States and in the UK will or will not find their way through into savings rates, which are still sub 1%. So part of the reason that we look at asset-backed investment is historically that's been the best way to protect your money, to grow your money. We still believe that to be the case. And there's no real alternative. No real alternative. Yes, you need cash. And Neil, you know, this is part of the planning process. Keep 3 months, 4 months cash accessible. Invest the rest. Set your goal. Set your how much, by when, and then leave that rest of it to us. We'll manage the money, and we'll also show you progress towards that goal.
And if we should just say, you've touched on the managers there. It's not just your expertise in this building.
No, at all.
You know, there are then thousands of employees at the likes of UBS, Goldman Sachs, Allianz, and so on, and
then again,
the
that's
new
what
managers on board,
we're
all
giving-
working on our behalf.
Yeah, that's what the clients are getting. They're getting access to those things that, you know, historically wouldn't have been available to them. So, you know, if you think Impulse Save, a single pound is getting across that fund manager network and that expertise working for them, and that's one level of the I suppose the diversification within the solution, but also the active management. And that active management, I think, is at two levels. You've got that active management which is ongoing within the individual funds that our partners are looking after for our clients. But then you've also got the allocation changes that Chris and the team are making there to those managers as well. So changes at the fund level, but then changes at the allocation level. So an actively managed solution seeking to deliver those goals for our clients.
Yeah, and Neil, just to come to you then, I mean, we've talked there around the kind of expertise that there is in this building and then with our partners as well.
Yeah.
From a client's point of view, who may well genuinely have, genuine concerns picking up the newspapers and things like this and seeing stories of volatility, is the message, look, you've made the best decision you're likely to make, which is to invest in the first place. Back that decision that you made.
Yeah.
Trust in the process, trust in the experts, trust in their expert partners, and just keep your eye focused on that long-term goal. Is that what we should be saying?
Yeah, definitely. And a lot of the conversations is, with clients is just what Jeff and Mark have talked about. We talk about the diversification of the portfolios. We talk about the asset allocation within the portfolios, how they work. We talk about maybe medium to long-term goals, which is more relevant within a pension because it's longer term and 25, 30 years. And that's the message that we give to our central clients. And once they listen to that, and once they listen to how the portfolios, the makeup of the portfolios, how we work, how we take a longer term approach, which may not apply to everybody, but especially in relation to their own personal risk and how that asset allocation is built up within their own personal risk, they are more assured when we speak to them.
I think that's an important point to bring out, that the clients, when clients join us, they go through the risk tolerance questionnaire, their attitude to risk, and clearly then we're aligning the portfolios with that attitude to risk.
It's almost like a replay of their circumstances, what they've done in the past and where they currently are. And once they can see the whole picture, then
it's a snapshot at a period of time, and if there is a failing in the questionnaires that are out there in the market, is it doesn't take into account the client's state of mind at that point in time. If you see somebody at 4 o'clock and they've had a great day, they might answer those questions differently. They've had a rotten start to the day, and you come and ask them with that. The other thing that we've built in with the technology, of course, is the ability to top up the investments. And in the early days of True Potential, David came up with a great example. He was saying, if your goal in a journey is to get from Newcastle to London, and you set off driving and you run out of petrol at Peterborough, you don't stay in Peterborough. You fill your car full of petrol to get to London.
Not that there's anything wrong with Peterborough, by the way, Mark.
There's absolutely nothing wrong with Peterborough. I usually see it about 100 miles an hour as the train flies through it. But that story you could apply to your investments. The technology, go onto the app. If you've got money and you can put it away, add to it. And Warren Buffett might say, being asked the question, when's the best time to invest? He said, when you've got money.
When you've got money. Well, it does play into another point around an opportunity. Now, I know we can talk about this, or you could appear to be talking about it flippantly, but we're not flippant. We understand that volatility is part and parcel of investing, but with volatility, Paul, comes opportunities. And I know that you are working on all of our clients' behalf to find the opportunities that exist in periods of volatility. How do you do that? Explain a bit about that process and what it means.
I think we don't just take what happens on one day. We look at broader trends, what's happening. We know we're in a regime where inflation is high. At some point, it will begin to moderate. It may have peaked already. What's the next regime? Thinking about disinflation. What are the assets that typically do well in a more of a disinflationary environment? So at the moment, we still believe we're in this inflation regime, and that inflation is going to be stickier for this year and well above the central bank targets. So we are preferring to be in large cap businesses, those with strong balance sheets, stable cash flows coming in, favouring UK equities still, FTSE 100 specifically, outward looking, global in nature, benefiting from some of the weakness that we're seeing in sterling, commodity sensitive sectors in there, and that's doing well for us year to date. It's actually delivering us a positive return. We're still a little bit cautious within fixed income. We're adding incrementally to sovereigns and UK gilts where bond yields have repriced significantly, but preferring alternative assets over fixed income still, and that's been the place to be. And year-to-date performance from our alternatives has been exceptional, and it's something that we've focused not only within Growth Aligned but within the True Potential portfolios for a number of years, really, knowing that bonds are expensive, preferring to take alternatives, and that's continuing.
I think you've also got to look at the positives as well, and not rose-coloured glasses, and there's opportunities out there, and I mentioned Warren Buffett just before there. Berkshire Hathaway have put $58.1 billion into the US market just last week. So that's commitment. And it's somebody who sees through the headlines and is making absolutely hard and cold investment decisions to employ capital into the market on behalf of clients. And that's our philosophy. We've got to do the best for our clients. That's why we're here, Peter.
Well, I mean, that's that in terms of you're looking for opportunities, but from a client point of view, and you mentioned impulse save before, and maybe it's a hard concept to get your head around, but equally it's a very simple one, that if markets are down, effectively, as you said before, Jeff, you mentioned, I think you mentioned Amazon and Netflix and other companies like that. If markets are down, effectively, you could be buying through your portfolio a share in those companies at a discounted rate.
Yeah, and I think that the point that Paul was making there is crucially important in that regard. It's about thinking about when we're building portfolios and structuring them, what are the longer term themes that we want to have exposure to, and that's when you can actually use shorter term market movements to take advantage of those and continue to reinforce that theme that you're taking. It's not in any way that we're saying that actually something has changed and we want to do that today. It's actually about there's a long-term strategy that sits behind the investment approach that we're taking, and that's what we're seeking to bring in and exploit when you're getting volatility, creating those opportunities, like you say. And that's the crucial difference between thinking about it, am I going to day trade it, or actually am I taking the opportunity that's been presented because it fits with my long-term investment strategy, which when you think about that, that's very much what we do within the portfolios, but it's what clients are doing as well, thinking about how do we help them achieve their goal. That's their long-term strategy. Our long-term strategy is to position the portfolios to deliver that.
Yeah. And Neil, perhaps the best advice we could give, as well as stick to your goal and what you originally said, would be speak to your advisor.
Yeah.
People like you who are out there, at the end of a secure message, at the end of a phone, at the end of an email, to pick up if clients have got any questions.
There's many ways to contact the head office advisors or your true potential advisor. You've got a lot of facility on the app where you can, like you said, Peter, contact through secure message. Or we've got a great customer care team upstairs who are in constant contact with our clients, our central clients. And our advisors are having conversations with clients, every day. Quite a few conversations, and myself, I've talked to clients about the current performance of the portfolios and the long-term outlooks, and like I said before, the diversification of the portfolios. But yeah, I mean, we would strongly recommend that if you're uncertain about a couple of things, or you maybe just want a refresh, or a lot of clients have annual reviews, please contact your financial advisor.
Yeah. Well said. Right, killer question then, but you all knew was coming, so nobody can complain. Looking forward then, let's try, if we can, without making any wild predictions, and as you say, Mark, it's a brave man to predict what's going to happen this time tomorrow, let alone a month ahead. But I guess what trajectory are we on? By we, I mean, global markets and the economy and all the rest. If you could just maybe answer that easy question in sort of 30 seconds.
How long have you got?
About 30 seconds.
30 seconds, right. Well, I suppose there's a couple of components to that question, and if we think about it, where markets are forward-looking discounting mechanisms, so they certainly are trying to price some of the things that we've been talking about, and where that's probably most evident is back to the bond market, where we have seen quite a significant move over the course of the start of this year in terms of where bond yields have got to. And at one point earlier in this week, the US 10-year was at 3%, close to where interest rate expectations are. So one could make an argument that the market is starting to reflect that changing interest rate psyche and has really priced it in there. And again, when you think about some of the equity markets as well, you think about NASDAQ, if we want to take that as a proxy for US growth, it's down over 20% year to date. So you're starting to see some pockets of where things may be pricing some of the worst of that outlook into them. But in terms of trying to call when that is, it's exceptionally difficult, and that's not what we're trying to do at True Potential. We're trying to position our portfolios to deliver for clients through that investment cycle. And if we look back through history, we look back through since the portfolios were put in place, that's certainly what they've done. When you think about the crises that we've had to deal with, we're speaking about now about the changes in interest rates, but even if we were to go back 2 years ago, it was COVID, go back before that, we all forget President Trump and the trade wars with China. So asset markets have to deal with these things in the background, but they do. And they look forward to how they then can earn returns going forward.
We did a whole year of podcasts on Trump, didn't we? I mean, it was great content for an entire year. Every tweet was, we're talking about volatility now. I mean, that was volatility generated by 200 and whatever it is characters. Do you miss him?
It'll not take 30 seconds to answer that one.
Well, look, Mark, for a kind of closing comment, I'll come to you. As I say, you set this business up in 2007 with the other 4 senior partners. It's a thriving business, and I'm not going to give the game away on the annual report, but it's coming out soon, and let's just say that this is a business that is thriving and thriving and proud to manage our clients' money as well. What is your overriding message to clients watching this or listening to this podcast who perhaps have seen the news, they've sent comments in? What's your message to them?
I think the main message is, if you've set your goal, stick to it, and let us navigate through the volatility. If you haven't set a goal for your investment, you're kind of in the wind a little bit.
Yeah.
So go back, speak to your advisor, and set a goal so you know your expectation of where you want to be and by when. And we will manage the portfolios, and we'll report back to you, and you can see exactly how you're progressing towards that goal. We set up the business, Peter. We had a business plan that we wrote even before we'd set up True Potential. It was there. We knew what we wanted to achieve for the company, and we're just about there. It will evolve, of course it evolves, but stick to your goal, and that's the message I've got. Our job is to reassure. We are constantly looking at the portfolios. We've brought in some new investment partners this year, and they're bedding in very nicely. But we make impartial decisions based on the information that we've got, so it's fact-based. We interpret that and we put it into action in the portfolios. And we are very, very mindful of clients and the way clients are seeing the news, the way clients are seeing the reporting that we give. And we must correspond, and we must communicate with everybody in a clear way, so that it's not to say that we want to turn everybody into investment nerds like Paul, but you've got to understand what's happening, and by understanding and by giving everybody information, it means that a client can make an informed decision.
Yeah, absolutely.
And hopefully that will be top up the investment if you have money, if you need to top it up, but just enjoy it as much as you possibly can, because we are looking after it.
I think that's it, and I mean, very well said. And I think, again, speaking as a client as well as anything else, I think, my takeaway is from this podcast is, back the 2 people you've already backed, which is number 1, yourself. You've made an investment, you've done the right thing. Now back the second people, which is these guys and their fund manager partners who look after your money and work, incredibly hard to do so. And I see that with my own eyes, and they're working very, very hard, and back yourself and these guys. Right, before we close off, it's a bit early to ask what you're doing for the weekend, because as we said at the start, we are doing this on a Thursday afternoon. So I won't ask what you're doing for the weekend yet, Neil. I suspect you probably need a bit longer to plan your weekend. I know they're very detailed. But what are you doing? What is you looking ahead to, maybe to Friday? What is the main thing you're looking forward to on Friday? What's the thing that you're looking forward to most, Neil?
Apart from a beer.
Well, I mean, I'd leave that till 5:30 if you wouldn't mind. I mean, I know it's been known to catch you in the kitchen having a pint at 12 o'clock, but ideally not.
I'm trying to clear my inbox then, because we are going on the road. So we're going,
of course,
on the seminars. So we'll be visiting all of our
Peterborough.
Yes. Well, not that close.
No.
London.
Yeah.
That's the closest, I think.
Yeah.
But yeah, we're going to be going up and down the country, north and south, visiting all our advisors and spreading the good word for what we've got to see around the portfolios, and what we're launching new. So yeah, I'll be clearing the inbox before we get on the plane.
And I would think also getting feedback from the advisor. So again, to clients watching and listening to this, we're out there talking to advisors to get the feedback that they're getting from their clients as well. So the seminars will be good for that as well, I would think.
Yeah, correct. Yeah,
good. Yeah, Paul, what's the highlight of your Friday? What are you looking forward to most?
I'm looking forward to waking up.
All right, well, that's
great. I'm realising that I'm not.
So are we, by the way. I mean, all being well.
No, I've got the day off tomorrow, so I can have a lie-in and have a relaxing day.
Oh, good. Well, I've got a job for you, by the way, for your Friday, which is you are the designated presenter. Well, you and Chris jointly shared presenters of the month. I feel like we should have had Chris, given that it's about relaxing and staying calm, I feel like we should have had our resident Scouser calm down on the podcast today, but never mind. But you can pop that on your
thank you
on your staircase or in the toilet somewhere, I don't know where, but well done on that one. Mark, your Friday.
Did you see how grateful Paul was to get that report and how award and how excited he was?
But it's shared, isn't it? So you
Well,
can't take the glory.
I don't know whether he's also blocking out camera 2's view of Jeff. I don't know whether he is or not, but
Paul, I would have kept that away from the camera. I would have taken it upstairs and cut Chris's head off it.
Yes.
And you are presenter of the month.
yes, and scribbled
So
the S off. And
That,
there you
that
go.
would have done it.
Yeah.
For me this weekend, much like Neil,
No, not the weekend. I want to know about Friday first.
Okay, Friday. Well, we'll be going back now to see what's happening in the US markets.
Yeah.
Tomorrow's a very busy day. Friday, it's not a wind down day at all for us. We're cracking on. And then Sunday, Peter, I'm going to see Newcastle play Manchester City.
Yes.
And then on Monday, we hit the road around the country.
Yeah, you're right. Well, and the first stop is?
Here, and then we're going to Strathclyde,
Yeah, okay, good.
followed
the
by
the North Tour. Yeah.
across to Ulster, and then Manchester into Leeds, then back up the A1.
I think that's been incredibly useful and reassuring. I hope it has been for you listening and watching as well. Don't forget, by the way, to subscribe to True Potential's YouTube channel, because if you do that, you'll get this kind of content, these kind of podcasts straight to your phone or whatever device you watch them on. And we'll also get morning markets, and Jeff and the team are here every single day to give you to cut through a lot of the noise, frankly, and just give it to you straight as it is and explain what a lot of it means. So do hit subscribe and you'll never miss a beat. But for now, thanks very much for watching. Bye for now.
Subscribing to the True Potential YouTube channel is quick and easy. Simply go to the channel on your desktop or through the YouTube app on your phone and click the subscribe button. You can then press the notification bell symbol if you wish to be notified as and when new videos are released. Doing this is a great way to keep yourself updated with market developments and personal finance insights. Thank you to everyone who has subscribed, and we look forward to continuing to help you do more with your money.